Welcome back to Iron Financial, the explainer series completely dedicated to helping you forge a stronger, absolutely resilient portfolio and helping you cut straight through all the structural weakness in today's market. I'm your lead analyst, and listen, today we are doing some very heavy lifting. We have to talk about the macroeconomic environment right now because it is just brutal out there. With interest rates staying elevated and the cost of capital getting increasingly expensive, these high multiple software stocks are facing unprecedented stress tests. I mean, any weakness in the concrete, any tiny crack in the foundation, and the market immediately brings in the wrecking ball. So today we're breaking down the latest and honestly highly contested earnings report from DocuSign, ticker symbol DOCU. But hey, before we start drilling into the numbers, make sure you hit that subscribe button to Iron Financial so you never miss a blueprint. All right, so today we've got a really fascinating architectural dilemma on our hands. DocuSign just reported their Q1 fiscal year 2027 earnings, and the blueprints look completely conflicted. We're talking incredible cash flows, major AI pivots, and yet we have a stock that just simply refuses to hold its ground under pressure.
That's right, and I'm the Market Skeptic. I'm here to represent you, the investor, by asking the really tough questions. We need to know, is this company actually pouring a solid long-term foundation for the future? Or are we just looking at a fancy, fresh coat of paint slapped over a crumbling, outdated structure? Because look, on paper, they beat the estimates. We all saw the headlines. But in reality, Wall Street is absolutely not buying the narrative. Let's look at the immediate market reaction to see what I mean.
Right out of the gate, here is a massive crack in the foundation. Despite a quote-unquote earnings beat, DocuSign's stock bled out nearly 5% in after-hours trading immediately following the release. Now, as an investor, you really have to step back and ask yourself, why? Why does a company surpass Wall Street's profit and revenue projections only to see the entire market slam the sell button? If the concrete is supposedly dry and strong, why are investors running for the exits? There is a serious disconnect here between the flashy headlines and the underlying structural integrity of this stock. You have to remember how the big players operate. Institutional money, they just don't care about a historical beat if the future looks weak. Hedge funds and asset managers are not paying you for the house you built yesterday. They are pricing in the skyscraper you are promising to build tomorrow.
Exactly. Hit the nail on the head. And to understand exactly why the market is aggressively stress testing this stock right now, we have to put on our hard hats and look way past the headline numbers. We need to measure the exact load-bearing capacity of their current quarter, and we have to stack that up against the strict expectations for the rest of the year.
Section 1. Inspecting the concrete numbers. Let's drill down. So, we need to determine if the underlying business, the actual tangible engine generating cash and securing enterprise contracts, is structurally sound, or if this former pandemic-era growth story is finally running out of steel. Let's start right at the top line, because the sheer scale of the revenue here is undeniably a pillar of strength. In the first quarter, DocuSign generated a massive $830.2 million in revenue. That represents a 9% year-over-year growth rate, and they successfully hammered right past the analyst projections, which were sitting at $825 million. Now let's put that into perspective. When you're operating in an environment of tightening enterprise budgets, where every single software expense is facing heavy CFO scrutiny, adding 9% to a base of this massive size requires some serious heavy lifting. They aren't just surviving the macro environment, they are actively expanding their footprint. In fact, 31% of that revenue is now coming from international markets, which essentially proves their architecture works on a global scale.
Market Skeptic. Look, I hear you, but let's be totally real for a second. Beating revenue by $5 million on an $830 million base, that is essentially a rounding error. Okay? It's a beat, sure, check the box, but it is absolutely not the kind of blowout quarter that forces short sellers to desperately cover their positions, and it definitely doesn't trigger a massive upgrade cycle from analysts. It's adequate scaffolding, I'll give it that, but it doesn't scream hypergrowth anymore. And here's the thing, if you are a software-as-a-service company in 2026 and you're trading at premium forward sales multiples, you simply cannot afford to just inch past expectations. You have to beat and raise aggressively. If you don't, your valuation multiple gets compressed instantly.
Fair point on the top line, but let's look at the bottom line because the structural beat here is much more pronounced. Wall Street modeled out 99 cents per share for earnings per share. But what did DocuSign deliver? An actual EPS of $1.09. A clean 10-cent beat on the bottom line. This is absolutely crucial because it proves that management isn't just mindlessly buying revenue at all costs. They are engineering deep structural efficiency into their operations. They pulled this off by systematically cutting the bloated pandemic-era headcount, strictly optimizing their enterprise marketing spend, and figuring out how to extract more actual profit out of every single agreement processed on their platform. That right there is a sign of a highly disciplined construction crew, keeping the material costs under strict control, ensuring that whatever top-line growth they do have actually flows all the way down to the shareholders. And when you pull it all together, management's current operation really is an absolute financial fortress. Look at this snapshot. They now boast nearly 1.9 million global customers and over 1 billion users worldwide. Think about the scale of that. But the metric that truly acts as the rebar in this entire concrete foundation is right down there in the bottom right corner, $289 million in free cash flow. That is a massive 35% free cash flow margin, sitting right alongside a highly impressive 32% non-GAAP operating margin.
Okay, I have to admit, a 35% free cash flow margin is completely ironclad, no arguing that. That literally means for every single dollar that comes in the door, 35 cents is pure, unadulterated cash that they can use to fortify the balance sheet, buy out smaller competitors, or buy back their own stock. But listen, this brings us right back to the central mystery. If the current structure is really this robust, and they're literally printing cash, why the after-hour sell-off? Well, because the market is entirely forward-looking. Like I said before, Wall Street doesn't pay for the building you already finished. They pay for the skyscrapers you plan to build next year.
Which brings us to Section 2, cracks in the forward guidance. Let's look ahead. We absolutely need to inspect the scaffolding for these upcoming quarters because Q2 is the ultimate stress point for this stock. Take a look at this table. For the second quarter, management says they expect revenue between $865 and $869 million. Now, yes, that's technically above the lowest analyst expectations, but barely. We are talking razor-thin margins of error here. But more importantly, check out the full fiscal year 2027 revenue guidance, $3.49 billion to $3.5 billion. That is perfectly, exactly right on the nose, in line with what analysts already modeled. There is absolutely zero upward revision here. And guys, this is the textbook definition of a value trap. In the current market environment, if you are a software company, you have to continually raise the roof on your guidance. If you just meet expectations and your growth stalls out, your stock immediately transitions from being priced on its explosive potential to being priced on its sluggish reality. Institutional money sees this flat projection, yawns, and immediately relocates their capital to better performing structures. There is simply no upward momentum here to sustain a premium valuation multiple. And honestly, it all comes back to this single glaring number, 9%. A single-digit year-over-year growth rate is simply not enough structural support to sustain investor excitement. Just think back a few years, remember? DocuSign was the absolute darling of the pandemic era. They were a total rocket ship growing at astronomical rates when literally everyone on Earth was forced to sign contracts digitally from their living rooms. But now, that rocket ship has turned into a slow-moving, heavy freight train. They are settling into the very dangerous reality of being a mature utility in what is supposed to be a hypergrowth sector. A 9% growth rate tells the market loud and clear that the days of rapid expansion are officially over, the company has completely saturated its core e-signature market, and fierce competitors, like Adobe, are actively eating into whatever market share is left. All right, let's move to Section 3. Is the AI just hype? We need to evaluate this IAM platform. Lead Analyst, because the saturation issue the skeptic just mentioned, that is exactly why DocuSign is pivoting so heavily right now. They know the basic e-signature market is fully built out. It's highly commoditized. To solve this very real growth issue, management has unveiled their master blueprint, the new AI-native Intelligent Agreement Management Platform, or IAM for short. This is their core strategy. This is how they plan to re-accelerate growth and finally break out of this single-digit slump.
Market Skeptic. But here's the ultimate question we have to ask in 2026. Is this AI platform actual, structural innovation, or is it just corporate fluff? Because let's be honest, right now every single tech CEO on the planet is desperately slapping the letters A and I onto their earnings slides just to artificially prop up their share price. We are seeing massive, unprecedented levels of AI washing across the entire software sector. We need to know if this intelligent agreement management system is actually driving net new revenue, or if it's just cheap drywall covering up the cracks of a saturated, failing business model.
Well, the concrete data actually suggests it is very real and highly lucrative. Let me read you a direct quote from CEO Alan Thajessen on this exact quarter's performance. He stated, "In Q1, we saw continued growing demand for DocuSign's AI-native IAM platform, with 40,000 customers investing in our rapidly expanding roadmap. Let's break that down for a second, because words matter. Investing. This isn't a beta test. This isn't some free pilot program they handed out just to boost their user metrics for the earnings call. That is 40,000 paying enterprise customers who've looked at these new AI tools, ran the numbers, and decided they are absolutely worth their capital. And we aren't just talking about some basic text generation feature here. They have built deep structural API integrations with major heavy hitters like Anthropic, Salesforce, and Microsoft. I mean, just imagine integrating Anthropic's AI to automatically read a 50-page master services agreement, perfectly flag any non-standard indemnity clauses, and route it directly to the legal department without a single human intervention. That is a massive, tangible cost saver for the enterprise. That proves the new AI materials have definitively passed the initial market stress test.
And look, the hard mathematical proof is sitting right there in the recurring revenue. The IAM platform already accounts for 12.6% of DocuSign's total annual recurring revenue, or ARR. Now, if you follow software stocks, you know ARR is the holy grail metric. It's the locked-in, highly predictable contract value that keeps the lights on and the cash flowing. For a brand new product category to already commands nearly 13% of a multi-billion-dollar revenue stream, that means it is rapidly becoming a brand new, massive, load-bearing pillar for the entire company. The structural identity of DocuSign is fundamentally changing. It's no longer just a simple place to digitally sign a PDF. It is rapidly evolving into a heavy-duty AI data extraction and workflow automation powerhouse.
Let's transition to Section 4, buybacks and retail sentiment. Time to follow the money. All right, I'll concede the AI adoption is a solid point in their favor. The numbers are real. But let's shift gears for a minute and analyze the psychology of the market here. How are the internal builders, the management team, and the external retail traders actually reacting to these underlying metrics and structural changes? Because often, simply following the money tells you significantly more about the health of a company than following the slick product roadmap.
Well, the ultimate signal of internal confidence is the record $318 million in stock buybacks executed during the first quarter alone. Think about that. When a company uses its heavy free cash flow to buy its own stock on the open market and permanently retire those shares, it shrinks the overall supply and automatically boosts the value of the remaining shares. Management is looking at their own blueprints, they're looking at the current share price, and they are aggressively deciding that their own equity is the absolute best possible investment right now. They are heavily reinforcing their own foundation and actively returning serious, tangible value to their shareholders.
And hear me out as the skeptic here, a massive buyback is exactly what a company does when they literally have no better ideas for how to organically grow the business, right? If you are a true hyper-growth tech company, you take that $318 million and you spend it on aggressive research and development. You go out and hire elite engineers and you ruthlessly dominate market share. Buying back stock, that is the playbook for legacy railroads and regional banks trying to prop up their EPS when actual growth dies. Meanwhile, look at the retail hype on the other side of the screen. Retail sentiment on StockTwits was marked extremely bullish, with message volumes absolutely soaring 1,200% over the last 30 days. This is classic textbook market misdirection. You have retail traders blindly piling in because they see the letters AI on an earnings slide and start mashing the buy button on their brokerage apps. Meanwhile, management is artificially propping up the bottom line with massive buybacks. But what did the institutional money do? The smart money, the algorithms, and the hedge funds. They looked at that sluggish 9% growth. They used that sudden surge in retail liquidity to quietly offload their heavy bags, and they dropped the stock 5% after hours. That is a massive architectural clash between retail hope and institutional reality. Which brings us to our final section, Section 5. The verdict. Is this an opportunity or a trap? Okay, we have looked at the concrete financials, we've analyzed the forward-looking blueprints, the AI integration, and the wildly conflicting market sentiment. It is time to render a verdict on DocuSign's Q1 FY2027 earnings. Is the stock of value trap slowly sinking into the mud? Or is it a heavily reinforced buying opportunity currently sitting in a major discount? Let's weigh the structural strengths against the stress points one last time, rapid-fire style. On the bull side, you have an absolute financial fortress. A 35% free cash flow margin and a 32% operating margin are elite, best-in-class metrics in the software space, period. They crush the EPS expectations, and they have successfully transitioned 40,000 enterprise customers to their new AI-powered platform, proving to the market that the pivot actually works.
Market Skeptic. But on the bear side, the stress points absolutely threaten to bring the whole building down. A sluggish 9% top-line growth rate proves the core business is heavily saturated and quickly losing momentum. And the completely flat, totally uninspiring forward guidance for the rest of fiscal year 2027 shows that even management themselves doesn't expect the AI platform to dramatically move the needle in the near term.
But you have to admit, the massive profitability gives them a nearly infinite runway to figure it out without taking on toxic high-interest debt.
True, but the market's ruthless 5% drop after hours tells you definitively that institutional investors are just exhausted. They are tired of waiting around for the next big boom, and they are actively taking their capital to faster-growing construction sites.
So, the data is laid out, the structure has been fully inspected, and now the hard hat is passed directly to you. Look at the concrete numbers we've outlined in this explainer today. Are you stepping in and buying the dip on a wildly profitable free cash flow machine that is successfully pouring a brand new foundation in AI?
Market Skeptic. Or are you sitting on the sidelines waiting for the dust to settle, avoiding a company trapped in single-digit growth purgatory with entirely uninspiring forward projections? Are they forging a new future? Or is this building condemned?
Let us know your verdict in the comments below. We want to hear how you're reading these blueprints. And, as always, to keep your portfolio structurally sound and protected from market weakness, make sure you subscribe to Iron Financial. We do the heavy lifting here so you can build your wealth with absolute confidence. Thanks for watching, and we'll see you on the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional.